So when you step into the world of macroeconomics or, corporate finance, the whole diagnostic landscape is just completely murky right now.
Oh, absolutely. It's totally opaque.
Right. I mean, you look at unemployment numbers, inflation indexes, all the interest rate chatter, and it honestly feels like trying to read tea leaves in a blender.
That's a great way to put it.
Yeah, there's just no clear x-ray for the global economy. But if you want to know what's actually happening out there, like what real people are experiencing in their daily lives, how they're spending their actual paychecks, and where the broader financial winds are shifting, you don't look at government estimates.
No, you really don't.
You look at the entities that are processing like billions of individual transactions. You have to look for the ultimate economic bellwether.
And honestly, there is no greater bellwether than the entity processing those transactions at just this unmatched global scale.
Right.
I mean, when we dig into the earnings call of the largest retailer on the planet, we are not just analyzing a single company's stock performance.
Not at all.
We are getting a high-resolution, real-time read on the financial health of the American consumer and, well, by extension, the global economy. Like the sheer scale of operating over 10,900 locations worldwide. It means this company detects behavioral shifts weeks, if not months, before those shifts ever ripple out into broader market indicators.
Exactly. So welcome everyone to a special Talk Tickers edition of The Deep Dive. Our mission today is to take this incredibly dense, Wall Street jargon-filled Q1 2027 earnings call from Walmart, which just took place on May 21st, 2026, and really just distill it.
Make it make sense.
Yeah, make it make sense. Distill it into a clear, actionable briefing specifically designed for you, the retail investor. We're going to look past the surface level headlines, extract the actual signals from the noise, and give you the most important takeaways for your portfolio.
Because we really need to understand the data and translate the financial terminology into plain language.
Right.
And ultimately determine what this all means for anyone holding, or even just considering, this stock. The value of this specific earnings call is that it provides a complete cross-section of society.
It really does.
I mean, they are selling groceries to families on food stamps, and then, in the same breath, premium skincare to six-figure earners, all while managing a supply chain that touches almost every country on Earth.
It's wild.
So when they report their numbers, it is a masterclass in macroeconomic reality.
So let's just dive straight into the raw data, because the numbers they just reported are absolutely staggering given the current economic environment. Like, we have to establish the scoreboard before we can interpret their grand strategy.
Right. Let's look at the headline numbers.
So they delivered constant currency sales growth of nearly 6%, which beat the top end of management's own guidance range by 120 basis points.
That is massive.
It is. But before we even touch the basis points, let's clarify the foundation here. Can you translate constant currency for the listener? Like, why does Wall Street care about this specific metric instead of just looking at the final dollar amount?
Sure, yeah. So it's a critical distinction for any multinational corporation. When a massive global company operates, they're taking in revenue in Mexican pesos, Canadian dollars, Indian rupees, Chinese yuan, dozens of other currencies.
Right.
And when it comes time to report their quarterly earnings, well, they have to convert all of that global revenue back into US dollars.
Right, to put it on the balance sheet.
Exactly. But currency exchange rates are incredibly volatile. If the US dollar is particularly strong during a quarter, those foreign currencies translate into fewer dollars. And if the dollar is weak, they translate into more dollars.
So the exchange rate can basically make their sales look artificially terrible or, artificially amazing, completely independent of how many actual products they sold.
Precisely. Like, if they sell 1 million televisions in Mexico and the peso collapses against the dollar, their reported revenue in dollars drops significantly.
Even though they still moved 1 million televisions.
Right. So constant currency strips out those foreign exchange distortions. It calculates the current quarter's sales using the exchange rates from the previous year.
Okay, got it.
So it gives you a true apples-to-apples measure of their actual sales volume growth. When they report a 6% growth in constant currency, it means people genuinely bought 6% more physical goods or services, or they paid 6% more for them, totally regardless of what the currency traders on Wall Street were doing.
Okay, that makes sense. And that brings us to the actual scale of that 6%. Because, in the world of hypergrowth tech startups, a 6% quarterly growth rate might sound like, a rounding error.
Right. It sounds small to some people.
Yeah, but we are talking about a company that generates hundreds of billions of dollars a year. Applying a 6% growth rate to a baseline that massive requires an incomprehensible amount of underlying momentum. It's not like steering a speedboat.
No, it's like trying to accelerate a continent.
Exactly.
To contextualize that math, guys, generating nearly 6% top-line growth at their scale is the equivalent of adding almost $10 billion in consolidated revenue in a single quarter.
Just in one quarter.
Yeah. In 3 months, they added the equivalent of an entire Fortune 500 company's annual revenue to their top line. It is a phenomenal display of gravity in the retail sector.
It really is. But this is where the financial terminology gets kind of thick and where I want to make sure we aren't leaving any retail investors behind. They beat their top-end guidance by, quote, 120 basis points. You see this term everywhere in financial news. Let's break down exactly what a basis point is and why Wall Street doesn't just use percentages.
Yeah, it's a good question. So a basis point, often abbreviated as BPS or pronounced BIPS, is simply 1/100th of 1%. So 100 basis points equals exactly 1%.
So 120 basis points is just 1.2%. Why not just say they beat guidance by 1.2%? Like, why complicate it?
It's basically to eliminate ambiguity, especially when you're talking about interest rates or profit margins that are already expressed as percentages.
Oh, I see where this is going.
Yeah, imagine a company has a profit margin of 5%, and the CEO gets on the call and says, our margins grew by 1% this quarter.
Right. Does that mean the margin grew from 5% to 6%?
Exactly.
Yeah.
Or does it mean the margin grew by 1% of the original 5%, meaning it's now 5.05%?
Ah, yeah, that creates massive confusion.
Right. So by saying our margins grew by 100 basis points, it mathematically guarantees that the margin went from 5% to 6%. It's an absolute unit of measurement that removes all doubt.
That makes perfect sense. Absolute clarity is required when billions of dollars are moving based on these transcripts. So they beat their revenue expectations by 1.2% or 120 bips. Top-line sales are just blowing past expectations. And looking at profitability, they guided their Q2 earnings per share, or EPS, to be between 72 and 74 cents, with the full-year EPS expected at $2.75 to $2.85.
This is very solid.
Very solid. But I'm looking at the relationship between these numbers, and I really have to push back on the underlying math here.
Let's hear it.
If top-line sales are up 6% and beating guidance, why did their adjusted operating income only grow by about 5%? I mean, shouldn't profit growth outpace or at least match revenue growth in a healthy business? Like, where is the money leaking out before it hits the bottom line?
And that is the exact discrepancy an investor needs to hunt for in an earnings report. It highlights the fundamental difference between top-line revenue, which is the total amount of money coming through the doors, and operating income, which is what's actually left over after you pay for the costs of running the core business. Things like inventory, wages, logistics.
Right, the stuff that keeps the lights on.
Exactly. Now, the 5% growth in operating income was actually in line with their internal projections, but it was heavily suppressed by two very specific hidden costs that acted as massive anchors on their profitability this quarter.
Unpack those anchors for us. What dragged down the operating margins?
So the first, and honestly the largest, was global fuel prices. The macro environment saw fuel costs just skyrocket during this specific quarter. And operating a logistics network that delivers 3.5 billion units globally, it requires an unfathomable amount of diesel fuel.
I can't even imagine the fuel bill.
Yeah, they had to absorb approximately $175 million in higher than expected fuel costs across their distribution and fulfillment operations. Management explicitly called out that this single factor was a 250 basis point drag, or a 2.5% reduction on their operating income growth.
Wow, 2.5% of their profit growth was just vaporized at the gas pump.
Vaporized.
That is a brutal reality of physical retail logistics. Like, you can have the best algorithms in the world routing your trucks, but if the underlying commodity spikes, you bleed margin.
You do. And the second hidden cost came from a completely different sector, actually. Healthcare.
Oh, really?
Yeah. Specifically, their pharmacy division faced a new maximum fair pricing legislation that was enacted in January regarding prescription drugs.
Interesting.
Yeah, this regulatory change forced them to lower prices on a wide array of medications, which created an additional 100 basis point headwind, so a 1% drag to their comparable sales.
Okay, so you have fuel eating into the margins on the physical logistics side and government pricing caps eating to the margins on the healthcare side.
Exactly.
And this brings up a really key strategic question. If fuel is suddenly costing you $175 million more than you projected, the standard corporate playbook is to protect your margins, right?
Oh, usually, yes.
You raise prices, you add a fuel surcharge, you basically pass that macroeconomic pain directly onto the consumer who is buying the groceries.
Right.
But based on the transcript, they didn't do that. Why would a company willingly swallow a $175 million loss in margin when they absolutely have the pricing power to pass it on?
Because they are playing a much longer, much more aggressive game.
Tell me about it.
So John David Rainey, their CFO, addressed this directly on the call. Instead of passing those fuel costs to the consumer and protecting the current quarter's margin, they deliberately absorbed that hit to protect their pricing perception. Yeah, they went on the offensive. They are heavily leveraging their everyday low price philosophy, which is, the foundational bedrock of the company.
It's essentially a war of attrition then. They're looking at the broader landscape and realizing that regional grocery chains and smaller competitors are also getting crushed by these exact same fuel spikes.
Absolutely.
But the smaller competitors do not have a fortress balance sheet. They are forced to raise the price of a gallon of milk just to keep their lights on.
Exactly. And when the competitor raises prices, Walmart intentionally holds their steady, just eating the margin loss in the short term. The consumer, who is also feeling the pinch of inflation, notices that the local supermarket is suddenly much more expensive while Walmart's prices remain stable.
And so the consumer shifts their shopping habits.
And Walmart scoops up their market share. They are buying long-term customer loyalty and permanent market share by basically weaponizing their massive balance sheet to absorb shocks that would bankrupt a regional player.
That is just a brilliant defensive posture masquerading as offense. But, this leads us to a massive logical puzzle that kind of defines the core of this entire earnings call.
Let's hear it.
Think about the math we just discussed. Fuel costs drag them down by 250 basis points. Pharmacy regulations drag them down by 100 basis points. They are actively choosing not to raise grocery prices to cover these losses, meaning their core retail margins are compressing.
Right.
If your core physical business is bleeding margin from all sides, how on earth did they still manage to grow their operating income by 5%? Like, what is pulling the plane out of the nosedive?
That question right there is the key to understanding the modern iteration of this company. The profit engines pulling them out of that nosedive are no longer what most people think they are. When you dig into the transcript, the traditional view of this company as just a massive seller of cheap physical goods, it completely shatters.
So give me the mechanics. What is actually driving the profit growth if it isn't physical goods?
It is their alternative revenue streams. Streams which are heavily digitized and command, frankly, software-like profit margins.
Interesting.
Let's look at the three pillars they highlighted on the call. First, global advertising revenue grew by an astonishing 37%.
37%.
Yeah, with 36% growth in the U.S. alone. Second, membership fee revenue driven by Walmart Plus and Sam's Club jumped 17%. And third, their U.S. marketplace sales, where third-party sellers list items on Walmart.com, skyrocketed by almost 50%.
Wow. I want to spend some serious time unpacking this because it represents a fundamental identity shift. The actionable takeaway for the retail investor here is that you can no longer evaluate this company through the lens of traditional retail.
You really can't.
You have to evaluate them through the lens of a tech ecosystem. Let's look at the mechanisms here. Selling a cheap gallon of milk or a discounted box of cereal in a physical store is practically a loss leader at this point.
Oh, totally.
It's just real-world user acquisition. Getting you into the physical store or onto the app is just the top of the funnel. The actual monetization happens elsewhere. They are operating the exact same playbook as Amazon or Apple. Like, the hardware or the basic service gets you into the walled garden. The high-margin digital services extract the profit.
And the transcript confirms this thesis in stark detail. Management revealed an incredible statistic on this call. Those alternative high-margin businesses, specifically advertising and memberships, now make up roughly 1/3 of the company's entire operating income.
1/3? Wait, really?
Yes.
1/3 of the profit for the largest brick-and-mortar retailer on the planet is coming from digital ads and subscription fees. That is a structural transformation.
It's a completely different business model than 10 years ago.
Let's break down how that advertising engine actually works, because a 37% growth rate at their scale is phenomenal. And when we talk about advertising here, we are not talking about billboards or television commercials.
No.
We're talking about retail media networks or RMNs.
Right. And retail media networks are currently the most lucrative space in digital advertising. In a landscape where traditional digital advertising on social media is being, hampered by privacy regulations and the deprecation of third-party cookies, first-party data is king.
Absolutely.
And nobody has better first-party data than a company that knows exactly what you buy every single week.
So let's illustrate how this works for the consumer. If you are a brand like Procter & Gamble and you want to sell more Tide laundry detergent, you could buy an ad on a social media platform and hope that someone scrolling through vacation photos happens to remember to buy Tide 3 days later when they go to the store.
Right. And the conversion rate on that is terrible.
Terrible. But with a retail media network, Procter & Gamble pays Walmart to place a sponsored ad for Tide right at the top of the search results when a user types laundry detergent into the Walmart app. Or they pay to have a digital display on the self-checkout screen right as the consumer is making a purchase decision.
And the purchase intent in that moment is infinitely higher. I mean, the consumer is already in the store, digitally or physically, with their wallet out, actively looking to buy that specific category of product.
It's brilliant.
Brands are willing to pay a massive premium for that placement because the return on ad spend is measurable and immediate. And for the retailer, once the digital infrastructure is built, the marginal cost of displaying that ad is practically zero. It is pure profit falling straight to the bottom line, which perfectly subsidizes the $175 million they lost on physical fuel costs.
Oh, wow. It perfectly covers it.
Exactly.
And the third-party marketplace, growing at 50%, operates on a very similar logic. For decades, their model was first-party retail. They bought millions of patio chairs from a manufacturer, put those chairs on a boat, put them in a warehouse, put them in a store, and hoped a customer bought them. They took all the inventory risk, the storage costs, and the logistics costs.
Right. Highly capital intensive.
But the third-party marketplace flips that model completely. Now, an independent seller lists their patio chairs on Walmart.com. When a customer buys the chair, Walmart simply processes the transaction and takes a percentage cut of the sale, often anywhere from 8 to 15%, just as a toll fee.
They take zero inventory risk.
Zero. They didn't pay to manufacture the chair or ship it across the ocean. They just monetize the digital traffic they already have. A 50% growth in this segment means their platform is becoming a mandatory distribution channel for independent sellers. It's directly challenging Amazon's dominance in the space.
It really is. And this transition from selling low-margin physical items to high-margin digital bits is fascinating.
Yeah.
But it goes even deeper when you look at their e-commerce and artificial intelligence integration.
Oh, right. E-commerce.
Yeah, global e-commerce overall was up 26%. But the most intriguing part of the transcript was their focus on Sparky, their native AI shopping agent.
Sparky.
Weekly active users for Sparky jumped over 100% just in the last quarter.
Let's dissect this because artificial intelligence in retail often feels like, a gimmick, like a chatbot that just frustrates you when you're trying to find a refund policy. How does this specific AI actually function as a revenue driver?
Well, they've moved far beyond the traditional clunky chatbot interface. They reported increasing Sparky's intelligence and response quality by 40% just this year. The mechanism here is behavioral psychology paired with generative AI. The goal is the complete removal of friction from the purchasing process.
Okay, give me an example.
Well, early on, consumers were using it for discovery. You might type, "Help me plan a camping trip for a family of 4," and the AI would generate a list of tents, sleeping bags, bug spray, that sort of thing. But the real revenue driver they highlighted on the call is personalized replenishment and meal planning.
Replenishment is the holy grail of grocery retail. It is the mental load of remembering that you're out of olive oil, paper towels, and dog food.
Exactly. And Sparky analyzes your historical purchase data. It knows you buy a 40-pound bag of dog food every 3 weeks. If you open the app, Sparky can proactively suggest, based on your history, you are likely out of dog food and olive oil. Would you like me to add them to your cart?
And the customer just clicks yes.
Right. It captures sales that might have otherwise been forgotten, or worse, gone to a competitor when the customer made a quick run to a local convenience store because they forgot an essential item.
It is the ultimate weapon against the forgotten shopping list. And they noted in the transcript that you can use it in store, and it even speaks Spanish now, widening the demographic net. But what is the actual financial metric tied to this? Does removing that friction translate into tangible revenue?
Oh, absolutely. The transcript provided a stunning metric on this. Customers who engage with Sparky have an average order value that is 35% higher than non-Sparky customers. Yeah. Units purchased through the AI grew more than 4 times since the previous quarter. When you remove the friction of searching for individual items and instead allow a highly intelligent agent to suggest complementary items and handle replenishment, the basket size just explodes.
A 35% increase in order value just by changing the user interface from a search bar to an intelligent conversational agent. That is an offensive growth engine running at full speed.
It really is.
But as we promised at the top of the episode, our goal isn't just to analyze the technology. We need to use this earnings call to take the pulse of the American consumer. And the transcript paints a very stark, very complex picture of what is happening on Main Street. We have this high-flying tech narrative, but what is happening in the physical aisles?
Well, management described a very clear dichotomy on the call. They called it a tale of two consumers. On one hand, you have high-income households who are spending very confidently. These are the consumers utilizing the digital tools, paying for the Walmart Plus subscriptions, driving the e-commerce growth, and opting for quick delivery. They are insulated from the macroeconomic pressures and basically prioritize convenience over cost.
And on the other hand, you have a consumer base that is flashing warning signs for the broader economy.
Yes, big warning signs. The lower income consumer is showing signs of real, tangible financial distress. The CFO noted a specific data point that should give any macroeconomic analyst pause.
Oh, I know the one.
For the first time since 2022, the average customer at a Walmart fuel station is buying less than 10 gallons of gas at a time.
Let's really grind on that metric for a minute because it is probably the most important macroeconomic indicator in the entire transcript. Less than 10 gallons of gas. I mean, when you pull up to a gas pump, the default psychological behavior is to fill the tank until it clicks. It's just the most efficient use of your time. If a consumer is deliberately stopping the pump at 7 or 8 gallons, or prepaying $25 in cash inside the station, it means they are managing their liquidity down to the dollar.
Absolutely.
They do not have the cash flow to fill up their tank all the way. They're just putting in exactly what they need to get to work for the week until the next paycheck clears.
It is a massive indicator of acute budget pressure. I mean, when a consumer is forced to buy gas by the gallon just to survive the week, every other discretionary purchase in their life is being ruthlessly eliminated.
Totally.
They're making very hard mathematical choices in the grocery aisles. They are putting the name brand cereal back and grabbing the store brand. They are skipping the electronics aisle entirely.
Honestly, if you are an investor holding stock in a restaurant chain, a discretionary apparel company, or a travel business, that 10-gallon metric should terrify you. If the consumer cannot afford a full tank of gas, they are absolutely not going out to a casual dining restaurant this weekend.
Right. And Walmart sees this distress in real time. Their strategic response is heavily focused on maintaining foot traffic from this stressed demographic. To assist these consumers and, prevent them from abandoning their carts entirely, management aggressively increased their rollbacks, which is their terminology for temporary price discounts.
Rollbacks.
Yeah. They currently have 7,200 items on rollback, which is an increase of more than 20% compared to the same time last year.
And they even highlighted a specific marketing initiative, launching a summer grilling basket that feeds 8 people for under $5 per person. That's not just a random promotion. That is a hyper-targeted lifeline thrown to a consumer who is desperately trying to stretch their dollar to provide a normal summer experience for their family. They're engineering the supply chain to hit a psychological price point under $40 for a party of 8 that a stressed consumer can actually justify.
And the data shows that this aggressive discounting strategy is working to maintain volume. Despite the intense budget pressure, U.S. store traffic was up 3%, and Sam's Club traffic was up 6%. They are successfully capturing the trade-down effect.
Explain the mechanics of the trade-down effect in this context for everyone listening.
Sure. So when household budgets tighten due to inflation or rising fuel costs, consumer behavior cascades downward. A family that used to shop at a premium grocery store like Whole Foods realizes they need to cut costs, so they start shopping at a mid-tier regional grocer.
Right.
And then the family that used to shop at the mid-tier grocer feels the pinch, and they trade down to Walmart. Because Walmart sits at the foundational layer of the retail ecosystem, they catch all the volume falling from the tiers above them. They gain higher income customers who are suddenly feeling budget conscious, which offsets the lower income customers who are reducing their basket sizes.
Okay, so let me summarize where we are. We have a deeply stressed, lower-income consumer managing their gas by the gallon, a massive corporate investment in discounting 7,200 items to keep them afloat, and an absorption of $175 million in fuel costs.
That's the setup, yeah.
This brings us to a massive logical collision when we look at management's guidance for the rest of the year. Having navigated this incredibly complex and margin-pressured first quarter, what is management signaling to Wall Street about the future?
Well, despite all the headwinds, the fuel costs, and the consumer distress, management is projecting extreme confidence. They reiterated their full-year guidance, expecting constant currency sales growth to hit the upper end of their 3.5 to 4.5% range.
So that is top-line revenue. They expect sales to stay strong because of the trade-down effect. But what about the bottom line? What are they projecting for operating income?
This is the guidance that kind of shocked the market. They expect Q2 operating income growth to actually accelerate to 7 to 10%.
Wait, I have to stop the tape right here and push back on this math, because on the surface, it feels totally contradictory.
I know, it sounds crazy.
If lower-income consumers are hurting so badly that they can't even fill up their gas tanks, and you are heavily discounting 7,200 items just to keep foot traffic up, and your logistics network is bleeding hundreds of millions of dollars in fuel costs, how on earth is management projecting an acceleration in operating profit to 7 to 10% for the next quarter?
Right.
If you are cutting prices and paying more for shipping, your profits should be compressing, not accelerating. What is the mechanical explanation for this?
It's a totally valid challenge, and honestly, it's the exact question every analyst was trying to model after the call.
Right.
To understand how they achieve that math, we have to translate a piece of core retail jargon used heavily in the transcript. Merchandise category mix.
Merchandise category mix. Break that down. Why does it matter what specific items people are buying if the total revenue is the same?
Because in retail, not all sales are created equal. The profit margins vary wildly depending on the physical item you put in your cart. Groceries, the essentials like milk, eggs, bread, and bananas, have notoriously razor-thin profit margins. A retailer might make mere pennies on a dollar selling groceries.
So why sell them at all?
The purpose of groceries is to drive frequency. You need milk every week, so you come to the store every week.
Oh, okay. That makes sense.
General merchandise, on the other hand, things like apparel, patio furniture, electronics, sporting goods, and beauty products have substantially higher profit margins. A retailer might make a 30% or 40% margin on a piece of clothing or a premium cosmetic.
So if a consumer comes in and spends $100 on groceries, the retailer makes almost nothing. But if they spend $100 on a winter coat, the retailer makes a massive profit.
Exactly. And for the past several years, due to historic inflation, consumers have been forced to allocate almost all their budgets to high-priced essentials. They were only buying groceries. The general merchandise aisles were ghost towns.
Which crushes margins.
Right. But on this call, management revealed a massive inflection point. For the first time in 18 quarters, that's 4.5 years, the company's actually selling a higher proportion of high-margin general merchandise relative to low-margin groceries.
Wait, really? After years of inflationary pressure where people were only buying survival essentials, they're finally buying the discretionary higher margin stuff again.
Yes. The specific shift in what consumers are putting in their carts contributed favorably to their gross margin expansion by 29 basis points.
Wow.
Management specifically called out apparel and fashion as a standout, noting that it led to the category's strongest share growth in 5 years. They also spent time highlighting the beauty category. They noted that a staggering 75% of the growth in beauty came from new premium brands they've aggressively brought onto the platform, specifically mentioning dermatological brands like La Roche-Posay.
Oh, this connects perfectly back to the trade-down effect we discussed earlier.
How so?
Well, the lower-income consumer isn't buying La Roche-Posay skincare. But the higher-income household, the one making $120,000 a year, who traded down to Walmart to save money on groceries, they are walking through the aisles, they see a premium skincare brand they used to buy at a high-end department store, and they just add it to their cart.
Precisely. The high-income consumer is subsidizing the margin pressure. They came for the cheap groceries, but they stayed for the premium beauty and fashion.
So when we look at the acceleration to 7 to 10% profit growth, the mechanism becomes incredibly clear. The flywheel is spinning on multiple axes simultaneously. You combine the recovering sales of high-margin physical goods like apparel and premium beauty with the exploding software-like margins of their digital ad network and the zero inventory toll revenue from their third-party marketplace and the recurring revenue of their subscription fees.
That's a perfect storm.
Suddenly, that massive profit acceleration makes perfect mathematical sense. Even if the lower-income consumer is mathematically constrained to buying store-brand milk and half a tank of gas, the high-margin digital businesses and the affluent trade-down consumers are completely lifting the foundational physical business.
Yep. And management also noted that some specific supply chain pressures from the previous year are beginning to ease.
Oh, like what?
For example, they suffered a massive margin hit, almost 100 basis points in Q1, just from egg deflation. When the price of eggs collapses, the revenue drops, but the fixed logistical cost of shipping a fragile carton of eggs remains exactly the same, which crushes the margin percentage.
Right.
They will begin to lap those difficult periods later in the year, which naturally aids the acceleration.
Got it. Now, what about the macroeconomic boogeyman that always haunts retail earnings calls?
Tariffs.
Did management address potential tariff impacts considering the geopolitical climate?
They did. And they were very explicit about how it factors into their guidance. Management clarified that their aggressive Q2 profit guidance does not assume any impact from Q2 tariff refunds. While they are actively participating in the recovery process for previous tariffs, they noted that the maximum refunds they might be eligible for represent less than half of 1% of their U.S. annual sales.
Okay, so it's essentially a non-factor in their core growth story. They're not artificially inflating their guidance based on the hope of a government refund check. They are building their financial projections entirely on the underlying structural strength of the business.
Exactly.
Well, this brings us to the final synthesis. We promised our listeners an actionable, distilled takeaway for their portfolios. We've analyzed the massive revenue beats, the $175 million fuel absorption, the rapid expansion of a high-margin digital advertising and AI ecosystem, the extreme distress of the sub-10-gallon gas consumer, and the margin expansion driven by premium general merchandise.
We covered a lot of ground.
We did. So when you synthesize all of this data, what is the verdict? Is this a bullish or bearish signal for the stock?
If you're evaluating this from the perspective of a retail investor looking for capital allocation, the verdict, based strictly on the data and strategy outlined in this call, is undeniably bullish.
I agree completely. And the thesis here is that this company is demonstrating a combination of traits that is incredibly rare in the current market environment. They possess absolute defensive resilience, simultaneously paired with aggressive, tech-enabled, offensive growth.
Historically, the thesis for buying this stock was purely defensive. It was a bunker stock.
A bunker stock, right.
You bought it when you thought a recession was imminent, because no matter how bad the economy gets, human beings will always need to buy inexpensive toilet paper, toothpaste, and groceries. You bought it for stability, not for massive capital appreciation.
But the actionable insight for someone holding or considering this stock today is that the historical thesis is dangerously incomplete. You cannot view them merely as a defensive brick-and-mortar retailer anymore. You have to evaluate their logistical and technological transformation.
Absolutely.
Let's look at the fulfillment infrastructure they highlighted on the call, because it rivals or exceeds the most advanced logistics companies on Earth. They noted that they can now reach approximately 60% of the entire U.S. population with 30-minute delivery.
Stop and consider the sheer physical infrastructure required to achieve that metric. 60% of the country in 30 minutes. They delivered more than 3.5 billion units globally on a same-day or next-day basis. Sales utilizing store-fulfilled delivery in the U.S. have more than doubled over the past 2 years.
It's mind-blowing.
They're effectively using their 10,900 massive physical retail stores as hyper-local, automated micro-fulfillment centers. Instead of shipping a package from a massive warehouse 3 states away, the algorithm routes the order to the store 3 miles from your house, and a driver drops it off in half an hour.
And their logistical dominance isn't confined to the U.S. either. In India, through their Flipkart division, they reported fulfilling orders in 13 minutes on average.
13 minutes?
13 minutes. That requires a network of urban dark stores and predictive algorithms that know what a neighborhood's going to order before they even click buy. In China, 75% of all their deliveries arrive in under 1 hour.
And we cannot ignore the automation frontier. On this call, They announced they hit a milestone of 1 million successful drone deliveries.
Drone deliveries, let that sink in.
Yeah, and over 40% of those million drone deliveries happened just in this most recent first quarter, indicating an exponential acceleration in adoption. They are currently airdropping orders, urgent items, medications, forgotten ingredients directly to customers' homes in minutes across 4 states.
When you combine that unmatched, hyper-local physical infrastructure with the massive margin expansion from their third-party digital marketplace, their booming retail media ad network, and an AI shopping agent that drives up order values by 35%, you are no longer looking at a traditional retailer. You are looking at a legitimate, high-margin, tech-enabled growth engine that uses physical groceries merely as a customer acquisition tool.
I couldn't agree more. However, to provide a balanced and responsible analysis, we must highlight the risk factors. What are the specific metrics an investor needs to monitor that could break this bullish thesis?
The primary risk factor is the breaking point of the lower income consumer. You have to watch that sub 10-gallon gas metric closely.
Exactly. While the company has the high margin tech revenue and the affluent trade down shoppers to buffer them right now, the foundational layer of their physical business still relies on immense volume from the working class. If global fuel prices spike even further, or if inflation reignites broadly and housing costs continue to squeeze budgets, the stress on that lower income consumer will compound.
If that consumer goes from buying 9 gallons of gas to 5 gallons of gas, or if unemployment ticks up and they lose their income entirely, the volume of essential purchases will crater. Severe consumer distress across the bottom half of the economic pyramid could force the company into even deeper, more desperate discounting just to clear inventory, which would eventually overpower the digital margins and compress their overall operating income.
The strength of the top of the pyramid cannot indefinitely subsidize a crumbling base. If the macroeconomic environment deteriorates rapidly, even the lucrative ad networks and subscription models will feel the tremor because brands will stop paying for ads if the consumer has zero disposable income.
It is a critical risk to monitor, but for now, management has proven they can navigate the turbulence.
They certainly have.
Well, this has been a masterclass in dissecting corporate strategy from raw data. To wrap up this deep dive, I want to leave you, the listener, with a final provocative thought. It is a new lens through which to view this company, based entirely on the mechanisms we have just unpacked.
I love it.
When you hear the data straight from the source that this company is executing airdrop drone deliveries in minutes in Texas, fulfilling e-commerce orders in 13 minutes in India, utilizing a native generative AI shopping agent that seamlessly increases order values by 35%, and generating a full 1/3 of its operating profit from digital ad networks and recurring subscription fees, you have to ask yourself a fundamental question about how you value this stock.
Right.
Are we still analyzing a traditional big box brick and mortar retailer that sells cheap t-shirts and bananas? Or has this company secretly, methodically transformed into an elite e-commerce, logistics, and data giant that just happens to have physical stores attached to its distribution warehouses?
When you frame it that way, the underlying financial architecture of the company is entirely unrecognizable from what it was a decade ago. It completely reframes how an investor should calculate its future multiples.
The picture of the global economy is a lot clearer now, but the identity of the subject we are analyzing has fundamentally changed. Keep looking past the headline numbers, keep questioning the mechanics behind the margins, and keep hunting for the signal in the noise.